Goldman Sachs have just issued another warning. It turns out that hedge funds are net short over the last week. But ahead of inflation numbers, do we need to be concerned? Hello, ladies and gentlemen, and welcome back to the special weekend show where we talk about stocks, commodities, and cryptos. We'll be discussing US oil. How high can it go, and how bad is it going to get for potentially inflation and the Federal Reserve? We also need to go into 50 years of economic data and break down the second week of September. This tends to be a bullish week, but what might surprise you is the streaks that the markets can go on. And of course, we need to look underneath the hood at the most important moving average, which is the 20. But that's not all. It's the biggest stock in the world, and it's about to release its new phone. Will the engulfing candle of last week lead into further short selling? Today we discuss the key levels for this big Titanic stock. Well, welcome back, everybody, to the Daily Show where we discuss macro leading indicators and, of course, the hottest charts together. We've got all of those coming up. Make sure to subscribe if you enjoy anything to do with markets. But let's break down the last week in detail. Semiconductors got sold heavily. The biggest stock in the world, Apple, got sold even more thanks to China bans. And, of course, Tesla down 3.71%. But what was more surprising is energy. Energy stocks hit some big critical highs, and we did see some dark pool transactions, which we'll be looking at later on in today's video, happening on oil. So could it already be over, and has this news already spread? Well, here's something that's very interesting. People forget sometimes how long we've been inverted. Often considered the worst economic indicator for a recession impending is the 10 versus 3-month spread of US Treasury yields. We've just hit the second highest ever. I posted this over on X, so make sure to follow us in the links in the description down below. But we also talked about this one here, which is Goldman Sachs. Goldman Sachs have seen the prime book, and basically it turns out that hedge funds are pretty much targeting semis, tech, hardware leading, and of course things to do with hotels, restaurants, leisure, financials, and machinery. They've been net short all of these particular sectors over the last couple of weeks, and they've kind of stacked a short position similar to March of 2023. Now, if it gets worse, we could be making new lows. But more importantly, we're looking for an unwind in this as well. If you're a bull, what do we need to see? We need a turn in the hedge funds. Basically, once they start unwinding and getting short squeezed, that's when you want to start buying. We'll be following that story throughout the next couple of weeks, so stick around for that. Bullish percent index, did that look any better? Well, before we go into the bull and the bear side, the bullish percent index actually made a new low. And this comes off making kind of like what we considered most likely a dead cat bounce in terms of the technicals. Could we be looking at capitulation next? Well, ahead of the inflation numbers, it's possible. And of course, this is the number that tends to ride huge amounts of volatility. Why is everyone even concerned about crude oil price? Well, number one, it's expensive. But number two, oil prices hit a 10-month high while US crude inventories are at a 40-year low. This chart kind of shows it all here. Some of the concerns in terms of how many days left, 46 days versus an average of 65 days for the US economy. And of course, during March 2020, we had 92 days left. So a big difference in crude here. And there are some concerns that the market is volatile on. But what is not volatile is the VIX. Now, of course, we will look at the VVIX later on in today's video, and that's the volatility of the volatility, which I expect to spike this week, and I think all of us do. But this is the 7th percentile. It's one of the lowest and cheapest points for hedge funds to actually enter into shorts. And I think that's why Goldman actually put out a letter last week, I believe, to their investors saying that maybe it was a good time to take some hedge funds or take some hedging positions as inputs in the market. It was cheap enough to do so. And of course, the stats for September and October tend to be all over the place. And yeah, it's surprising when you think about it because, of course, the retail herd, that's us, voted that 42.2% of us were bullish last week as of Tuesday. And of course, we saw what happened. The markets kind of floated on down after that. Only 29.6% were bearish. So we've kind of like flicked the switch on the bears. The bears were back. Now they've seemed to have gone and everyone wants to buy the dip. Will it continue that way? Well, of course, we'll look at that data in just a second. 93% of people, or at least the market participants, expect that the interest rates will stay on hold after this inflation number. But that could change. And of course, we'll be looking very closely at yields, particularly the long-term curve of the next 2 years. It's really interesting when you look at how the market's got that so wrong over the last couple of months and where we've gotten back to. So let's break down 50 years of economic data. It's pretty much known that September is the worst month of the year. But what tends to be a pretty good period of time is September 9th to the 19th. Yes, the second week of trade tends to be pretty good. And in fact, it's got a 34 positive to 16 negative rating. But I want to just focus on the last 3 years. Take a look at this. In 2020, 2021, and 2022, they've all been negative. And what you might notice is that it tends to go on epic streaks. Basically, when you have this sea of positivity, it tends to last for ages. When you have a sea of negativity, it tends to last for a while. So could we be going on another kind of streak similar to this? Well, the last 3 years would actually show you that this could still be a weak period of time, even though the data stats present 34 positive to 16 negative. We also know that the week after, the post-OPEX week, that one tends to be really negative. 17 up, 33 down, with the last couple of years certainly being more negative than positive, so playing around with that stat, and then 50-50 into the end of the month. Here's another chart just to show you those stats in a little bit different breakdown. So when does it sell? Well, it tends to usually be the back end of September that gets the worst, which is probably why hedge funds are protecting themselves right now. And in pre-election years, as we mentioned, we tend to get a double dip. We always knew we were probably going to sell August, and of course, we got that one correct together. However, we also believed there would be a rally into possibly a secondary dip. And this secondary dip often takes new lows. Now, if that's the truth and we do end up getting new lows, how low can the S&P 500 go without finding buyers? Well, we kind of speculated that if we break below 43.30, that we could be going towards 4,200 and 41.50. And this seems to be kind of the consensus, I think, of a very good demand zone. And in fact, the most traded zone of the last 2 years happens down there. For investors, do you need to be concerned about markets, or are you getting excited about markets? Traditionally, people often look at things like forward PE to kind of figure out whether the markets are cheap or not. At the moment, we're trading probably around 18.4-ish to 18.6. So we're not really super expensive, but we're certainly not cheap. If that got more into the underneath 17, I think a lot of you would be very interested in taking some investments. But at this stage, it's just not happening on these charts. And of course, it's something to keep in mind. Let's move over now to dark pool and leading liquidity. So we saw some hedge funds probably in the shorts last week. ProShares short S&P 500 SH fund ended up pointing towards a large volume trade. This is probably a short-dated trader having a go at possibly predicting a sell-off. Did it occur? Not yet. Let's look at also some other things that are going on. FDN, which has some large trades to do with Amazon, Meta, Google, Cisco, and a few others in it. These are the largest companies inside this fund. 6th largest trade coming through here. And it all happens back at these highs. So you could kind of see this being some potential profit targeting. And while it could be an entry towards a new rally, which we'll have to look at, it also could be a pretty heavy sell. I think the good thing about this is it's a coiled market. So once you see a breakout either way, we should know what that was, whether it was a sell or buy. I'd guess it was a sell at this stage. We also got a nice large trade going on in financials. Now, this is a little bit unusual, but as we saw, Goldman Sachs have already referenced financials was one of the hedge fund sells last week. Maybe it was a buy now that we all know about it, but at this stage, 26th largest trade, marking out the new highs and marking out the lows will certainly be important here for financials. Make a new low, probably going all the way back down to around 32.50 on XLF. If we make a new high, I'd say that we do end up getting towards a new all-time high here, potentially on the financials. As you can see, we'd snap that one and probably keep moving up even maybe higher. So there's a lot at stake this week into inflation. Let's now take a look at rotation and options. The largest trades, where were they? Well, turns out that we had quite a lot of trades in Tesla and Nvidia. Now, was that a trap for retail traders? We won't know yet, but 1.44 and 1.34 times 90-day average. We also saw the biggest stock in the world, AAPL, finding some big trade, 1.67 times average volume, with everyone stacking into the call side. If we go down, what was happening? Well, it was 53% calls and 47% puts on a fairly neutral day with around normal average volume. Expect that to spike up into, of course, the Wednesday this week, which will be inflation. What about rotation? Was Wall Street getting defensive for another day? Well, we know that, of course, inflation-based trading, which is often financials and energy and metals, well, they've been doing pretty well. Energy itself, 0.97 on the day. Utilities coming out with another strong session. Same with staples. Healthcare was flat. Semiconductors led the low. So it was turning a little bit defensive, and it takes our 5-day average here for the markets. All of a sudden, bam, there they are. Utilities, healthcare, and maybe not staples at this stage, but 2 of the 3 defensives suddenly the best performers over a rolling 5-day average, along with the inflation-based trade of energy. Now, while we did see selling in energy, this is the first time that we've seen this in kind of like a month and a half where the market's actually turned either any defense at all. Really, it's just been selling defensives. Suddenly, we've been buying them again. So are we getting ready for a little bit of a double dip September? Well, I think we'll know once the price action confirms a few things, which we'll look at now that we're jumping into the charts. So US 2-year, this one, 5.1%. We've all talked about it together. We need to set those alerts there. And we also need some alerts on the 10-year as well coming into the inflation. I've got here a set alert at 4.335. If we get a daily close at these levels, not a wick, but a close, this is going to be a big deal. We're in the fear of the unknown then. And markets hate that. When markets go into an area where they're not sure about something, that's when they start to freak out. So I think yield watch will be all over the place this week. We also know that we've got things like treasuries, which are in super focus. A lot of you guys looking at this thinking, ooh, maybe I want to take some trades. We ended up jumping up, creating a small island reversal down here. We saw a little bit of a rally through the session, but no follow through from that. I still think we need to get above 97.38 at this stage to show us a turn, to show us some kind of trend change, but also focus is on 88 to 90. This is a super long-term low here for treasuries. And if we do wipe these lows, of course, if inflation gets worse, which a lot of people do expect the fight against inflation to go on for quite some time now, kind of like in stagflation, I guess you would say, then we could be moving towards $88 and $90. And if we do for treasuries, wow, that'll be a super level. Everyone will have lost faith at that point. The volatility of the volatility did drop a little bit, but I expect this to kind of spike up into the inflation numbers. Effectively, CPI on Wednesday probably will drop after that unless it was bad. But yeah, I don't expect the volatility to stay so low at this stage. And here is the change on the percentage of stocks above the 20-day moving average. Wow, what a difference a couple of days can make. Back down into 35s, and certainly it's looking more and more like that was a false rally. But it all comes down to closure levels, and of course we'll look at that soon. The skew here, yeah, not really getting crushed, kind of in the middling zone. So for bears, definitely watching that to see whether it keeps falling. Stimulus for China, now in focus again because we're seeing weakness across iron ore and weakness across copper. It looks like the market's getting kind of like upset at not enough stimulus coming out of China. We get an engulf candle on copper towards the weekly, and that's showing us again that there might be some troubles as well brewing in the second biggest economy in the world. But I still think they'll try to defend it. We'll find out whether we're correct on that thesis, I think, very soon. The US dollar is approaching a critical level. In fact, it closed pretty much right on what we thought last week, which is 105.16. And it was a very strong week coming off this incredible hammer rejection here. It doesn't look like it's turned trend. There's nothing like that. But I would say this is highly likely where the US dollar could top out. Otherwise, if it doesn't top here, it's going towards like 107, which is a speculation area we've had before. Gold wasn't doing too well as, of course, we saw the US dollar go so strongly. This is a pretty weak looking candle, a shooting star candle or pin bar coming straight off into the daily 20 here. I don't really like what I'm seeing here on gold spot. It tends to have kind of like a week, 2 months here. We were hoping for a stronger August. It was kind of crappy, really, the August. It wasn't that great. And GDX is therefore holding on to dear life at this stage. And I like gold stocks. I think they're pretty good on the investment standpoint. If we go into stagflation, they should perform well. If we go into a rate cut environment, they should perform well. And we do have a turn of trend here, but this was a slightly scary Friday market. You'll notice I marked out 28.82. I think if we end up getting a close above that, it's a significant sign because that's a super scary looking candle. And of course, it's pointing towards, going and testing lows or even 26.50 again. But if that gets wiped and it goes back up above, well, I think that'll be a very strong sign actually for gold stock traders. And I think the stocks present better value at this stage than the spot at the current price. US oil, what's going on there? Well, it turns out that it's getting closer and closer to $90 a barrel. This one will spike this week. It looks like it's going towards 90 to 92 a barrel. I don't see much resistance on the left-hand side or much stopping it. So to me, it's kind of like a free run at this stage. And while I'm not really on this trade, I do think that if you picked it up, especially on this day here, which was the 31st of August, very strong trading by you and certainly a pretty good level to see the change of trend there. Once that happened, we snapped off this high. It was pretty much inevitable it would try to track into this green box. I still expect it to get to the green box. I'm hoping it goes there earlier than the inflation numbers, kind of like a buy the rumor, sell the fact event. What's going on with Tesla? Well, it keeps hovering around the same zone. In fact, if we go down to the 2 hours, you can see here it's kind of like getting a tighter range. It's kind of like coiling, and when you get a coil, usually you get an explosion of a move when it does come out of that coil. At this stage, we've got our lows marked, we've got our highs marked, and really all you're doing is marking those two on your charts and saying, okay, once we breach one, we either move up to the next level, which will be up here, or, of course, we're going all the way back down to potentially 220, 210 for Tesla. I don't know the range on this yet. It depends a lot on what the market does next, and we'll go through that soon. What about AAPL? Pretty weak market news. So weekly engulfs back down. Technically, it's a very bad-looking chart, and it points towards further selling for the biggest stock in the world and the markets as a whole. And we do see here the Friday, it couldn't hold the rally. So it basically sold that rally straight up and moved back down. Of course, new lows will be on watch this week. 172, we close underneath there. Back down to 160 we go. I actually think we'll go to like 156 or something on AAPL at that point and sell quite considerably. This is a mixture of what's going on with, of course, the China stuff, but also I think it's just a sign of the times for the markets. They're just pulling back a little bit here. Here's another one. We've got semiconductors in focus, NVIDIA. A lot of you guys watching this, of course, you have a gap down. If you get a gap up, probably strong day trade for a lot of people. Island reversal there. But I've marked out 448.72, the previous low. If we get underneath that level, kind of marks, I think, that we could be going towards 402. And we know 402 is a super duper demand zone. And if that ends up getting broken in the future, think about it this way. This could either be a BC, this could be a UT and a UTAD as per Wyckoff. If that's part of a huge distribution, then you could be getting some seriously cheap NVIDIA. Well, not cheap, but much better priced NVIDIA on the horizon. It had a monster run. And remember, these levels, especially this yellow line, I believe are super critical. And what we're seeing on stocks like AVGO, which is, of course, Broadcom, and I'll bring that up for you guys now, is a very different story to what everyone's thinking. This looks like a monster distribution as well. Now, it could be wrong. Of course, markets aren't always the way that you think they are, but this is not a stock I would usually buy. It's one that I would usually fade over a 3 to 6 month period. And I have my reasons, but it's got to do a lot with the over massive stimulus that kind of came through here when everyone got hyped on AI. I do think that there are some big sellers going on, but like NVIDIA, the amount of large transactions tracked through those highs is just considerable. Would I short NVIDIA? Absolutely not. I wouldn't have a go at doing that. But, AVGO, it's a bit different stock. Let's take a look at CQQQ as we go into the indices now. So the Chinese stocks back at their defended line. This is usually where we see stimulus come out. It's kind of like something breaks when we get a new high on yields, the US 10-year and 2-year in America. Then we usually see stimulus around here. So all eyes will be on China and potential stimulus for the stock market. I have a suspicion if it gets too much lower, we'll see some kind of announcement. I'm not saying it's the biggest thing ever. It'll be just something to try to support that level. The German market holds again. Now, it had a doji, and then a huge wick rejection. I mean, in principle, it looks pretty strong. If we do end up getting a closure above the high, it's kind of showing you that the strength is there and there were buyers. But imagine if we took that low with a big bear candle. Ooh, I think this is absolutely not safe. The strong 15,450, it would not be safe at that point. It would more than likely break. Statistically, there'd be a good chance of that. The Aussie market recovered after selling pretty brutally into the demand zone. I do think there are buyers here for the Australian market at this stage, but if we take a new low, then we'll have to reassess. We knew this was a weak period. We knew this is a strong period. At this stage, we're in neutral or bullish territory. US 2000, big bear kind of candle. Back to, I would say, like a little bit of buying pressure, but I don't really like the US 2000. If you're going to buy it, this is the zone from a technical day trading standpoint. Have a look at the Qs, though. The Qs are all over the place. The NASDAQ recovered after bouncing off the 20-day moving average. Take a look at that bounce. Boom, straight up. but it's the US 500 I want to focus on. So let's have a look at the S&P 500 here quickly. So this is the 20 moving average, and we know that it loves it. The 20 moving average on the NASDAQ has been absolutely stellar. The 20 moving average on the S&P 500 recently has been a great buy and sell level. So we've found 2 days of kind of pressure support here. And I do think on Friday there would have been a couple of buyers, and they would have bought literally on that dot. So about 448, 449. Some people will have said, well, I think there could be a buy here. And they're doing it because this level was taken. 44.70 was taken. A new high was bought out, but instantly was rejected back. Bulls this week just need a new high. They get a new high. There's a good chance we're going towards 4,500 for the next kind of bear pressure. And I could see people liking this level. But if the bears were trapping here, and of course the entry here is already up and almost break even, usually you'd break even that point and around here, then you would be looking towards, 44.30 kind of thing, 4,400, maybe even 43.30 as the next stop. So I think very important economic data coming out, but more importantly, that's great small time action. And it's holding that daily 20 as best it can. Look at those wicks. So you can see if we get a daily close underneath here, it's going to be significant for the bears and a big win for them. But the bulls are just trying to say, do not let it through the daily 20, because the daily 20 is probably one of those like position traders concepts at the moment. There'll be position traders that'll say, once we get through daily 20, we're going to take buys and we've changed trend. And once we're rejecting or finding support on daily 20 recently, we've been positioning in, etc. This is super important zone. And I think that puts it in perspective so you guys can see it on a chart. Let's move over to Bitcoin. Nothing. I do like the Bitcoin ETF spot. I think it's a big deal. But if we take a look here at where we are for Bitcoin, still trapped, still coiling. I still think I'm negative on it. September tends to be the worst month of the year for Bitcoin. It does tend to have a little bit of a bad run here as well during the halving event cycle. So I do think Bitcoin could go worse, but I am bullish on it over a 12-month period here. I'm actually getting more bullish on it as I think about some of the catalysts that could come through. This is what I did last time. And I just think that, you've got to sometimes follow some seasonal events and also some catalysts that are coming up. Core CPI and CPI are the big economic data events of this week. Wednesday, September 13th at 8:30 a.m. New York time. This is what everybody's eyes are on. I expect it to be up. So does the market. Of course, CPI is expected to jump to 0.6%. So don't be surprised if that's what it is. And we're going to a year-on-year 3.6%. So the market does expect inflation to be worse. But what if core goes up for whatever reason? They're going to be freaked out at that point. So watch your yields and make sure to stay on top of those. Also, quick reminder, we've got an FX Evolution competition. We're giving away 4 tickets to our Vegas conference coming up in only 13 days. If you're interested in buying tickets as well, we have a couple of different options in the links down below, so definitely check them out. And hopefully I get to meet you in Vegas. We've got ex-Goldman Sachs options guys. We've also got CMT traders and some specialists at particular indicators that I think a lot of you would get a lot of value from. So definitely consider checking out in the conference tickets down below. And thank you so much for subscribing and smashing that like button. Have a great weekend, everybody. We're ready for a huge week this week. Mass volatility, and it's the worst month of the year. Catch you soon.